What are the implications of China decoupling from the US and decoupling from Australia for that matter? That's a theme that's been occupying Morningstar's head of equity research, Peter Warnes, and he joins me today to talk about that. G'day, Peter.
Thanks, Lex.
Now, in the latest overview, you say China is starting to decouple from the rest of the world and driving toward greater self-sufficiency. What would the effect of this be for the US for a start?
Well, for US, it could be quite dangerous. I still believe that, the US need China more than China needs the US. If you look at the US investment in China, it is substantial. For them to pull up stumps and go to Wisconsin, I don't think it's even, it's not in their mind, it's in the mind of the White House. And so the US needs to get access to 1.4 billion people. They mightn't have the firepower individually that the US has, but collectively, they are the biggest spenders out there. And I think that decoupling from there, I don't know what the cost would be. As I said, labour is a very, very important ingredient of the economic pie, if you like. Capital and labour, you put those together, add technology, add brain power and what have you, and out comes the other end, whether it's a good or a service.
Yeah.
The efficient way of doing that is getting low-cost capital and low-cost labour, and you know what happens to your margin. And capital being mobile and much more mobile than labour, capital gravitates to the cheap labour source. That's what globalisation is all about. It's matching the two and getting them together.
Yeah.
And they complement each other. Pulling that apart would be incredibly difficult. And then if you look at China's average hourly wage rate of $4 US at the top versus the US at nearly $25 US, well, how does it work? What's the product going to cost you if you move, as I said, from Guangzhou to Iowa? Or if you want inflation, that's one way of getting it. But I don't think economically it would work, and I don't think there'd be an avalanche of companies wanting to go down the Trump path, because I just don't see how it works. Look at the US corporates again. As I say, the auto industry is a perfect example. There's more. I think there's more cars or autos manufactured south of the border than there is north of the border. Why? They don't speak Spanish or Mexican or whatever.
Yeah.
They probably don't like the food.
Yeah.
But the fact is, the labour's cheaper.
Okay. They're obviously turning towards Australia and China. There have been rumblings about barley and other commodities, but you say the most important one is iron ore, obviously. If China to suddenly back off and show less interest in our iron ore, that would be the serious factor, wouldn't it?
Well, iron ore exports to China exceed $100 billion a year. I mean, iron ore makes up nearly 55 to 60% of all our exports is iron ore. We are privileged because we have the highest grade of iron ore in the world.
Yeah.
We are located in terms of freight very advantageously compared to the competitors. And Brazil Vale is the number one competitor, but don't forget there's a lot of development coming down the stream in Africa. But Africa is a long way from China, like South America is.
Does that mean that a company like Fortescue Metals Group should be in everybody's portfolio?
Oh, that's a big call. It all depends on price, and because as I said, I don't believe that the iron ore price is going to collapse from 120 to 42. I mean, I know Morningstar says that, but what I say, that's my thoughtful disagreement streak in me. I don't have to agree with what they say. They don't have to agree with what I say.
Sure.
But you put it all together and say, well, where's the line of best fit or what have you? But I think that whilst China has been throwing a lot of money and stimulus at infrastructure, which is heavily biased towards steel, which happens to be, need iron ore or whatever. This whole infrastructure thing started probably about 20 years ago, gained momentum 10 years ago, coming out of the GFC.
Yeah.
But that stuff that was built 20 years ago, it'll be scrapped. They'll either rebuild it or they'll use the scrap, and of course that also will take some of the impetus out of the iron ore, because scrap will be used rather than the ore, but the ore will still be meaningful. Now, but everywhere else in the world, and of course China just happens to be the biggest out there. Everywhere else in the world, what are governments and the stimulus packages all about? They're all about shovel-ready infrastructure, etc., etc.
Yeah.
I mean, if there's one word or two words that's been used more than unprecedented, it's been bloody shovel-ready. Well, all those things need steel. So I think yes, Vale will get their act together, and Brazil and China will favour them. China will go down that route, believe you me. Particularly, they don't particularly. I'm not saying they don't like Australia, albeit if every country in the world put a for sale sign in them, China would try to buy Australia.
Yeah.
It wouldn't buy any other country, in my opinion, than Australia. They like Australia. They don't necessarily like Australians. All right? At the moment.
Yeah.
All right? There's been a bit of a argument.
Yeah.
So, but yes. So if we lost half our iron ore exports to China, the impact, the economic impact would be meaningful, because net exports have been a very, very substantial prop of GDP growth over the last few years. But it can be lumpy. But that's just because of iron ore.
Okay.
And until we get a few other things in place, in other words, we've got a robust household consumption, and we've got some business investment and what have you, supporting GDP growth, we can't afford for this other thing to fall off a cliff.
Still on China, you made the somewhat sort of revelation in inverted commas during the Morningstar Individual Investor Conference that you raised the idea of getting into Chinese ETFs. We hear constantly about the rising Chinese middle class, as well as all this steel making and production. And then there's obviously the technology component. You heard Hamish Douglas today talking about Ant Financial Group, talking about Alibaba, Tencent. A Chinese ETF, is that a safe haven, dare I say it, and a good way to sort of ride the dragon?
Well, Lex, it's all about, I think you've got to have a diversified portfolio, and diversification is very, very important, given, and even more so when there's more uncertainty. So all I'm saying is that if I'm anywhere near correct, that the Chinese economic growth has, over the last 10 years, and is more likely over the next 10 to 15 years, to exceed any of the economies in the developed world, individually or collectively. If that premise is correct, and given where the markets are, you'd go back and have a look at the March lows and current markets. The CSI 300, which is a Chinese number one, if you like, this is Shanghai Composite and what have you, but we use the 300. It's up, I think, it's up far, far less than NASDAQ or the S&P, about in line with the ASX. So in terms of value, and because I think the US dollar's coming down, I would be very cautious about moving in the US. But I might want to put some money in China. And you can't pick the stocks individually. The Magellans can, the Peter Warneses and the Lex Halls shouldn't.
Sure.
Because you'll need a shotgun approach there rather than a rifle. And so I think the best way is through that ETF. And I think I saw the other day, the Van Eck ETF on China, and I said, I think the code is CNEW. Just look, it's around about the $9.50 mark or what have you.
Right.
That would, if I was going to do that, and it's front of mind at the moment, that's how I will get exposure to China.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.